When it comes to investing, one of the most common dilemmas new investors face is choosing between index funds and mutual funds. While these two options often appear similar, especially to beginners, they are fundamentally different in terms of how they operate, what they cost, and what kind of performance you can expect. Both are investment vehicles made up of a diversified pool of assets, like stocks and bonds, but the way they're managed, priced, and used in portfolio strategy makes a major difference in long-term outcomes. This video explores the top 10 differences between index funds and mutual funds, explaining each in simple, practical terms to help you make informed investment decisions. 1. Passive versus active management. The most significant difference between index funds and mutual funds lies in their management style. Index funds are passively managed, which means they simply aim to replicate the performance of a specific market index, such as the S&P 500 or Nasdaq 100. They do not try to outperform the market, instead, they mirror it. Mutual funds, on the other hand, are typically actively managed by professional portfolio managers who attempt to beat the market by selecting stocks or other assets they believe will perform better. This fundamental difference affects everything from performance expectations to costs. 2. Cost and expense ratios. Because of their passive nature, index funds usually have much lower expense ratios than mutual funds. Managing an index fund requires minimal day-to-day decision-making and fewer transactions, which keeps operating costs low. Mutual funds, with active management, come with higher fees to pay for research teams, trading, and the expertise of fund managers. These fees, often ranging from 0.5% to over 1% annually, can eat significantly into your returns over time. In contrast, some index funds charge as little as 0.03%. Making them a more cost-effective option for long-term investors. 3. Performance consistency. Index funds aim to match the performance of the market, which tends to grow steadily over time. This means they are often more predictable in the long run, especially in diversified indexes. Mutual funds, however, can be hit or miss. Since they rely on a manager's ability to beat the market, they may outperform during some years and underperform in others. The average mutual fund does not consistently beat its benchmark index, which is why many investors end up disappointed after paying higher fees for average or below average returns. 4. Investment strategy. The investment strategy behind index funds is straightforward. Buy and hold all, or a representative sample, of the securities in a given index. There's no human judgment involved in which stocks to include, just a commitment to follow the index. Mutual funds use a wide range of investment strategies based on the goals and style of the fund manager. These can include value investing, growth investing, sector rotation, or even market timing. While this may seem like a potential advantage, it also introduces more variables and risks that can affect the outcome. 5. Tax efficiency. Index funds are generally more tax efficient than mutual funds. Because they involve fewer trades, they realize fewer capital gains, which helps investors minimize their tax liabilities. Mutual funds, due to active trading, may generate short-term capital gains that are taxed at a higher rate. Additionally, mutual funds distribute these gains to investors even if you didn't sell any shares, which can result in surprise tax bills at the end of the year. For investors in taxable accounts, this difference can significantly impact net returns. 6. Transparency and holdings. Index funds offer more transparency because their holdings closely track a known index. You always know what assets the fund is holding and how they're weighted. This allows investors to evaluate risk and exposure easily. Mutual funds, in contrast, are less transparent. Managers are not required to disclose holdings daily and may only provide quarterly updates. This lack of visibility can make it harder for investors to understand what they own and assess how it aligns with their overall portfolio strategy. 7. Accessibility and minimum investment. Index funds are often more accessible to beginner investors. Many providers, especially online platforms and robo-advisors, offer index funds with very low or even no minimum investment requirements. Mutual funds frequently have higher minimums, often ranging from $500 to $3,000 or more, which can be a barrier for entry-level investors. Moreover, mutual funds may be available only through specific brokerage firms or retirement plans, whereas index funds can be widely purchased across various platforms with more flexibility. 8. Rebalancing and turnover. Index funds have very low turnover rates, meaning they buy and sell assets infrequently, usually only when the underlying index changes. This passive approach contributes to lower transaction costs and greater stability in holdings. Mutual funds, by contrast, often have high turnover rates due to active buying and selling. This not only increases costs through trading fees but can also introduce more volatility in the fund's performance. High turnover may also reduce tax efficiency, as it can trigger taxable events more frequently. 9. Performance attribution. With index funds, performance attribution is straightforward. Your returns are directly tied to the performance of the index being tracked. This makes it easier for investors to set expectations and measure success. In mutual funds, performance is tied to the skill, or lack thereof, of the fund manager. You are relying on their ability to make the right decisions at the right time. While some managers may outperform in short windows, very few do so consistently over long periods, making the strategy more of a gamble than many investors realize. 10. Ideal use in portfolios. Index funds are ideal for long-term, buy-and-hold investors who value simplicity, low fees, and predictable market-matching returns. They are commonly used in retirement accounts, college savings plans, and general wealth-building strategies. Mutual funds might be more suitable for investors seeking specific exposure or who believe in a particular manager's strategy. However, due to higher fees and variable performance, mutual funds are often best reserved for sophisticated investors who can actively monitor and evaluate fund choices. Most financial advisors today recommend index funds as the default for most retail investors. While index funds and mutual funds might seem interchangeable at first glance, their underlying differences significantly impact your investing experience and financial outcomes. Index funds offer low fees, transparency, and consistent market tracking returns, making them ideal for most investors who prefer simplicity and efficiency. Mutual funds, on the other hand, offer more strategy-driven opportunities with the potential for market outperformance, though with higher costs and more risk. Understanding these differences is crucial when building a portfolio that aligns with your goals, risk tolerance, and investment style. Whether you're a beginner or looking to optimize your current strategy, knowing when and how to use each fund type can set the foundation for lasting financial success.